Welcome to our video on the stock market. In this video, we will be diving into the world of stocks and shares and explaining what the stock market is, how it works, and why it's important for both individual investors and the economy as a whole. Whether you're new to investing or just looking to brush up on your knowledge, this video has something for everyone. So sit back, relax, and join us as we take a closer look at the stock market. Introduction to the stock market. Definition of the stock market. The stock market is a marketplace where publicly traded companies' stocks are bought and sold. It is a platform where companies can raise capital by issuing stocks and investors can buy shares in those companies, becoming part owners. The stock market allows companies to access a large pool of capital, while also providing investors with the opportunity to earn returns on their investments through stock appreciation and dividends. The two main stock markets in the United States are the New York Stock Exchange, NYSE, and the Nasdaq. And the two main stock markets in India is BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Purpose of the stock market. The main purpose of the stock market is to provide a platform for companies to raise capital by issuing stocks, and for investors to buy and sell those stocks. By issuing stocks, companies can access a large pool of capital that can be used for growth and expansion. In turn, investors can buy shares in those companies and become part owners, with the potential to earn returns through stock appreciation and dividends. Additionally, the stock market also serves as a barometer for the health of the economy, as the performance of stocks is closely tied to the overall performance of the economy. The stock market also allows for efficient price discovery and allows investors to easily buy and sell assets. How the stock market works. Buying and selling stocks. When buying and selling stocks, an investor is buying or selling a small ownership stake in a publicly traded company. The process of buying and selling stocks typically takes place on a stock exchange, such as the New York Stock Exchange, NYSE, or the Nasdaq in USA, and the National Stock Exchange, NSE, or the Bombay Stock Exchange in India. To buy stocks, an individual must open a brokerage account with a stockbroker. Once the account is open, the investor can place an order to buy a certain number of shares of a specific stock at a specified price. The investor will pay the specified price, plus any additional fees or commissions, to the brokerage. The brokerage will then execute the trade by buying the shares on the stock exchange. To sell stocks, the process is similar. The investor will place an order to sell a certain number of shares of a specific stock at a specified price. The brokerage will then execute the trade by selling the shares on the stock exchange. The investor will receive the specified price, minus any additional fees or commissions, from the brokerage. It's worth noting that the price of a stock can change rapidly and frequently, depending on the supply and demand in the market, and other factors such as company performance, industry conditions, and global events. The role of stock exchanges. Stock exchanges are organizations that provide a platform for the buying and selling of stocks and other securities. They act as a marketplace for investors to buy and sell stocks, and facilitate the trading of stocks through a centralized location. The main role of a stock exchange is to bring buyers and sellers together and to provide a mechanism for the efficient price discovery of securities. When an investor wants to buy or sell a stock, they place an order with their brokerage, which then sends the order to the exchange. The exchange matches the buy and sell orders and facilitates the trade, ensuring that both the buyer and the seller are satisfied with the price. Stock exchanges also provide a level of transparency and oversight for the securities market. They have strict listing requirements for companies that want to have their stocks traded on the exchange, and they also have rules and regulations in place to protect investors. Exchanges also provide real-time information on stock prices, trading volumes, and other financial data, which is widely used by investors and analysts. In summary, stock exchanges are important institutions that play a central role in the functioning of the securities market. They provide a platform for the buying and selling of stocks, promote efficient price discovery, and provide oversight and transparency in the securities market. The importance of supply and demand. The concept of supply and demand is one of the fundamental principles of economics, and it plays a crucial role in determining the price of stocks in the stock market. When demand for a stock is high, it means that more investors want to buy shares of that stock, which in turn pushes the price of the stock up. Conversely, when demand for a stock is low, it means that fewer investors want to buy shares of that stock, which causes the price of the stock to go down. On the other hand, the supply of a stock refers to the amount of shares available for purchase. When the supply of a stock is high, it means that there are many shares available for purchase, which tends to put downward pressure on the price of the stock. Conversely, when the supply of a stock is low, it means that there are fewer shares available for purchase, which tends to put upward pressure on the price of the stock. The relationship between supply and demand is important to understand because it helps investors to identify trends in the market and make informed decisions about buying and selling stocks. For example, if an investor notices that the demand for a stock is high and the supply is low, they may conclude that the stock is undervalued and that the price is likely to go up in the future. On the other hand, if an investor notices that the demand for a stock is low and the supply is high, they may conclude that the stock is overvalued and that the price is likely to go down in the future. In summary, the stock market is a marketplace that is driven by the forces of supply and demand. The supply and demand for a stock has a direct impact on the price of that stock, and understanding the relationship between supply and demand can help investors make informed decisions about buying and selling stocks. Types of stocks. Common stocks. Common stocks, also known as equities, are a type of security that represents ownership in a publicly traded company. When an investor buys a common stock, they are buying a small piece of the company and becoming a shareholder. As a shareholder, the investor has the right to vote on certain corporate matters, such as the election of directors and the approval of certain actions, such as mergers and acquisitions. They also have the potential to earn returns on their investment through stock appreciation, as well as dividends, if the company pays them. The value of a common stock is determined by the market and is affected by various factors such as the company's financial performance, industry conditions, and the overall economic environment. Common stock prices can fluctuate rapidly and frequently, which can create volatility and risk for investors. However, common stocks also have the potential for significant growth and long-term wealth creation. Common stocks can be bought and sold on a stock exchange through a brokerage account. It is also important to note that some companies may have multiple classes of stocks, such as Class A and Class B, with different voting rights and different financial rights. In summary, common stocks are a type of security that represents ownership in a publicly traded company. They give investors the right to vote on certain corporate matters and the potential to earn returns through stock appreciation and dividends. However, the value of common stocks is determined by the market and can fluctuate rapidly, creating volatility and risk for investors. Preferred stocks. Preferred stocks are a type of security that represents an ownership stake in a company, similar to common stocks. However, preferred stocks have some key differences from common stocks. One of the main differences is that preferred stocks typically do not carry voting rights, unlike common stocks. This means that preferred stockholders do not have the ability to vote on corporate matters, such as the election of directors or the approval of mergers and acquisitions. Another key difference is that preferred stocks typically pay a fixed dividend, rather than the variable dividends paid by common stocks. The fixed dividend is generally paid at a higher rate than the dividends paid on common stocks. Additionally, in the event of a company's liquidation, preferred stockholders have priority over common stockholders in receiving their share of the company's assets. Preferred stocks also have a preference in terms of claim on assets and earnings prior to the common stockholders. Preferred stocks can be bought and sold on a stock exchange through a brokerage account. They are often considered a hybrid between bonds and stocks because they offer a fixed income like bonds but also have an equity component. In summary, preferred stocks are a type of security that represents ownership in a company, similar to common stocks. However, preferred stocks do not carry voting rights and typically pay a fixed dividend at a higher rate than common stocks. Additionally, preferred stockholders have priority over common stockholders in the event of a company's liquidation, and also have a preference in terms of claim on assets and earnings. Thank you for watching our video on the stock market. We hope you now have a better understanding of what the stock market is, how it works, and why it's important. Remember, investing in the stock market can be a great way to grow your wealth over time, but it's important to do your research and understand the risks involved. As always, please consult with a financial advisor before making any investment decisions. Thanks again for watching, and make sure to subscribe to our channel for more informative videos like this one.